So this idea that it's a flight to quality or a flight to safety is reasserting itself here. The reason we believe Bitcoin went down after the ETFs were introduced is because there was a lot of anticipatory buying before Bitcoin or the ETFs came out.
Hey guys, welcome back to Everyday Finance. In this video, Cathie would discuss about Bitcoin and other crypto. According to Cathie Wood, during the March regional bank crisis, Bitcoin prices went up 40%, the regional bank index was falling apart, and now it's happening again. Things were acting up. And after a small drop after 11 ETFs where he brought up the idea that Bitcoin might catch a bid again, it's either a flight to safety or safety is making its case again. Here's the reason we think Bitcoin dropped after the ETFs were brought in, because there was a lot of buying in anticipation. Before, when Bitcoin or the ETFs came out, there was a bit of a sell-off on the news. These are the traders who buy and sell at the best times, and lots of things Cathie would discuss, so please watch the video to end, and share this video, and subscribe our channel Everyday Finance. Thanks.
Many people call Bitcoin digital gold. We would put it in that category, a store of value, a risk-off asset. And last year, during the regional bank crisis March, Bitcoin shot up 40% as the KRE, the regional bank index, was imploding. And here again, the regional bank index is acting up. And after a little bit of a correction, after 11 ETFs were introduced, we are seeing Bitcoin catch a bid again. So this idea that it's a flight to quality or a flight to safety is reasserting itself here. The reason we believe Bitcoin went down after the ETFs were introduced is because there was a lot of anticipatory buying before Bitcoin or the ETFs came out. There was a bit of the sell on the news. These are the trading types who just are very opportunistic in that way. As you know, or if you've been listening to In the Know, 15 million of the 19.5 million Bitcoin outstanding are in what we call strong hands. They haven't moved their Bitcoin in more than 155 days. And this chart just shows you that even relative to gold, Bitcoin has been rising. There's now a substitution into Bitcoin. And we think that is going to continue now that there is a much easier way, less friction-filled way to access Bitcoin. And you can check out in our big ideas what we think the impact of institutional participation in this market is going to be on Bitcoin's price.
According to Cathie Wood, 15 million of the 19.5 million Bitcoins that are still in circulation are in strong hands. It's been more than 55 days since they moved their Bitcoin, and this picture just shows that Bitcoin has been going up. There is now a way to switch to Bitcoin and do that again now that there is a much easier way with less FR. There is an easy way to get Bitcoin, which you can see in our big thoughts on what we believe the effects of institutional involvement in this market will be about the price of Bitcoin. What strikes us is that credit default swaps in this setting, prices are going down for both investment grade and high return when many businesses start to see their sales go down. That's very interesting to us, but you can see how quickly this can change in late 2018. There was a major change in the fourth quarter in the stock market. Let's back to the Cathie Wood interview.
And then just to throw another wrinkle into the discussion, we are struck that credit default swaps, both for investment grade and high yield, are coming down. in this environment where for many companies, they're beginning to see revenues go down. That's very interesting to us. But you can see how sharply this can move in late 2018. There was a serious correction in the stock market. I think it was the fourth quarter. And actually, back then, NVIDIA led the decline. It was cut, as I mentioned earlier, by 2/3. And there was just this reverberation through all kinds of markets. Like, what's going on here? And credit default swaps shot up pretty sharply. And you can see what happened during COVID. And then again, you can see what happened in 21 and 22 as the Fed was talking about in 21 and then actually raising interest rates in 22. Lots of fear out there. Now there seems to be complacency building in, and it has to do with this soft landing that seems to have become the consensus forecast. We do think that's going to be shaken up as companies lose pricing power and start laying more people off. And so we think this will reverse, and the flights to quality will get another bid out there. And we do think also, I'll just continue to give a plug for innovation-based strategies. They were absolutely creamed in here, certainly paid their dues, while the NASDAQ and others were hitting all-time highs. We think that innovation-based strategies will hold in much better because, as Brett described, we've hit prime time for a lot of innovation. And we think that earnings and revenue growth rates are going to be protected from this rolling recession that we see because our companies, for the most part, help companies with margin pressure solve that problem. You see a lot of layoff announcements. And one of the reasons you're seeing these announcements is revenue growth for many companies has gone negative. In fact, in what I would call the traditional world or the old world, the non-digital world, we're seeing negative revenue growth, 3M, minus 4.5% year over year. That's volume and price down. That's the equivalent of nominal GDP. UPS down 7.8% on a year-over-year basis. And these companies touch the world, and maybe that's what's going on right now. China seems to be in a downward spiral. Certainly its stock market is looking that way, and the statistics are disappointing. Perhaps the debt load associated with 20 years of buy-the-dip property transactions in China reached an untenable point. Many statistics out of China are negative. And Europe, by some measures, is in recession. So maybe these multinationals are suffering more because of what's going on in the rest of the world. But I do think we are not isolated from the rest of the world. So again, lots of confusion. And anyone who's been listening to In the Know for a while knows that I've been saying it's going to be very confusing. And this is just one indication. Just one more thing before I introduce you or reintroduce you to Brett. When I first started in the business in the late 70s, I was in college. I heard portfolio managers back then talking about the worst mistake they had made in their lives, their professional lives. In the early 70s, after we went off the gold exchange standard and all hell broke loose, prices started going crazy. We had the oil embargo, quadrupling of oil prices. Most economic indicators were in nominal terms. They didn't break out real from price or real from inflation. And because of that, they looked at earnings exploding, and they could not understand why the market was going down. And they kept buying the dip, buying the dip. It was a big mistake, because what was happening back then was inflation was the only reason earnings were going up. And the market doesn't pay for earnings caused by inflation. And so that's when we started separating inflation from real growth. And we've been there ever since. Today, we might be on the opposite side of that problem. Now, most portfolio managers, as they're gauging the health of the economy, they look at real GDP. And inflation is just a separate metric that they know the market doesn't pay for. So, well, that's okay until you run into negative money growth negative revenue growth caused by falling prices, companies losing pricing power.
According to Cathie Wood, there is a link between gold and 0% interest rates. Some people would say the ratio has a strong relationship with the yield on 10-year government bonds when the value of gold has gone down compared to metals. The purple the line goes up. Rate of interest goes up when it comes to awards. Gold goes up since the purple line goes down. Loan rates have gone down too. The Fed began to tighten. This relationship ended in early 22. The number has been going down. Or the value of gold has been going down of gold compared to metals has been going up. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.